Okay, so now we get to this detailed thing. So I don't want you to get perturbed or overwhelmed by the amount of data that you're going to see. But these are like, these are isolated things. You have different clients. So when you're doing these, imagine yourself as a tax consultant who has like a lot of clients, lot of clients, because that's what you're going to be once you become CPAs, right? So once you have a lot of clients, imagine people coming from different industries, having different compensation scenarios, and how should you be accounting their income on their tax return? That's what we're going to do. So I've just reproduced an extract of 1040 that we just saw in the form earlier, right? So one thing is, of course, your wages. Now this is a big thing. Okay. If you are a household employee working at an employer, so if let's say there are people staying in the US, and US the compensation that you pay for household wages is not less. Okay, so if you have somebody who's working for you and you're paying household wages to that person above a particular threshold, which is defined every year, above a particular threshold, you will have to deduct the TDS and then submit, provide a W-2 to that employee, and you become an employer professionally. Can you understand this? Can you understand the impact of this? We had a colleague of ours whose mother wrote a book, and I still remember we were asked to, provide the raw material for that book. So we were the people who were given questionnaires, okay? And that book had something to do about the Indian family and how's the evolution of the Indian family going to happen with women working and with joint family system breaking down. And at that point of time, I remember there is a history that says that wherever India is today, we look at Britain, and Britain 50 years back, like, you look at what India is and you go 50 years. So you go 50 years back towards what Britain is, and that is what India is currently. So imagine, because see, I also understand that if you do this, you're trying to address all of that illegal immigrant labor that is coming to the US, because a lot of them survive. I have seen situations where people say that they go to the US and then they have their children, and when the children grow up, then that is the time when they apply for the residency and citizenship of their parents. Now that's a big problem in the US, and with the Tax Cut and Jobs Act coming, this was an attempt to make sure that all of those illegal immigrants could be put on hold, because the moment you will have to disclose their payments via household wages, it's a big deal, right? So this is applicable. Okay. Tip, when you get, so tip in the US is a big thing, right? At, I don't know, at some point of time it was 30%. People who are residing there would know it better, but it's a big amount. You cannot go and you cannot eat. So I was being told that with the advent of COVID and everything, nowadays people include tip and then they ask you to pay, which is also happening in India with tip and service charges, but then the amount is nowhere in comparison to what is in the US, right? So they have a law for tip also. They say that if the tip is reported, what is the time when the tip has to be disclosed to the books? If the tip is not reported, even then you will have to include it in your accounts and you have to pay tax on it. So if somebody is being receiving a tip by working in the hotel or somewhere else, and that tip is not being reported, you report it now and pay tax on it. And if you're reporting it to your employer, then the year in which you're reporting it, in that year you're going to pay tax on it. In other words, let's say if the tip is reported, okay, so every month you get tip, and let's say next month you report that tip to your employer by the 10th of next month. Okay, so what would happen? Let's say it is October, it is November, it is December. So October you reported in November, November you reported in December, December you reported in Jan of year 2. So this amount you will not offer for taxation in year 1. These two would offer for taxation in year 1. And any tip that you did not report, you will have to clearly now report it on Form W2 on 1040, and you have to pay tax on it. Okay, so they have a rule for tips, and can you see it is on the face of 1040? It's that big an amount for them. Then you have the Medicare wage payment not reported. Okay, then we have these dependent care benefits. We have employer provided adoption benefits. There are some deadlines. There are some minimum exemption limits given to you. Until that amount, you don't pay tax. But the moment the payment given by the employer for either helping you stay on work and provide for your dependent care benefits, or helping you adopt a child, And in that case, the adoption expenses, there is a limit to which it is exempted, but anything beyond that limit is taxable. Then we have these other income, and so all of these income, apart from all the other, and if you remember, there was Schedule 1 which had other income details along with the adjustments that was reported. All of that will flow to in your form 1040. Okay. I showed you this, right? Now see, there's a Dhobi list of all the things that you have to report. I will not give you a question on each one of them because some of them are just normal self-explanatory stuff. But some of them which are a little complicated or something which needs a little bit of explanation, I have tried to give you questions on that. Okay. So general rule, if you're receiving something as salary, wages, overtime, premium, all of that is taxable at the rate of fair market value on the date of receipt. Of course, that will include vacation pay, sick pay, holiday pay, prizes, bonus, commissions, tips, all of that. Then you have this business expense reimbursements. Okay, we are going to talk about this in great details. Okay, we are going to talk about what is an accountable plan, what is a non-accountable plan. Now, what is an accountable and a non-accountable plan? Think of it like a very simple stuff. Okay, now all of us at some point of time when we have worked, we have traveled, right? And when you travel, there can be two kinds of arrangement that the employer can give you. The employer can say, "See, I'm going to give you this amount." So let's say every time I have a travel, employer comes and tells me, I'm paying you 1,000. I don't care how much you spend on it. Whatever you spend, you spend. Whatever you don't spend, you keep. That's the first kind of an account. The second account says, I will pay you $500 in advance. When you come back from your travel, you give me all the expense proofs, and then the amount that is left. Let's say the employee went abroad or the employee traveled, spent $400. When you come back, the balance that you did not use, you've got to pay back that amount to me. Now, this kind of a plan is called an accountable plan. That means the employee is accountable for the expenses that he or she is incurring, and they will have to substantiate it to the employer. And in case if the amount is more than what is being spent, then the excess have to be returned to the employer. A non-accountable plan, on the other hand, is a plan where there's a blanket money given and no accountability of the expenses asked for by the employer. Now, obviously, in a non-accountable plan, the entire amount is taxed in the hands of the employee. So imagine such a bad thing, right? Here, whatever is the case, nothing is taxed. But in this case, the entire amount, even the amount that I'm going to legally spend and working for my employer, even that amount will be taxed in my hand. So, in other words, the IRS would want you, because even the employee would want it, right, to have an accountable plan rather than a non accountable plan. So, in this case, entire amount is taxed. In a non accountable plan, only nothing is taxed actually. If you can substantiate everything properly and if you return the excess to the employer, nothing is taxed in your hand. Okay? And there's something called the health savings account, which is for the employee. And if the employer or the employee is making a contribution to that, that's taxable. You would have certain, so we're going to talk about fringe benefits in a lot of detail, but if there are fringe benefits that are either purely taxable or I have given you a threshold, like the adoption benefits that we spoke about or the educational assistance, there's a particular amount. Beyond that amount, it will be taxed. Okay, again, this is a kind of a fringe benefit the employer gives you. They say that there's a group term life insurance policy. Now, see, always understand that all of these are like fringe benefits. So, when I say fringe benefits, there are two kinds of plans possible. The first kind is non discriminatory. That means I can have a clerk in my office getting the same plan, I can have a director in my office having a same plan. It does not differentiate between highly compensated employees. On the other hand, if it's a discriminatory plan, then it is in the favor of only some very high. So ESOPs, you will see in many places in India. I don't know in the US, ESOP plans work a little differently in the US, but in India, whenever we had ESOP payments, first of all, there are many companies who provide this only to people in certain upper levels, not to people in the levels which are below. And second, there are some cases where When you have an ESOP, there would be some value, and the ESOP will depend on whether you're going to get the differential or you're going to take the stock and then sell different kinds, right? But remember, the first fundamental concept of fringe benefit is if you want a tax benefit, it has to be a non discriminatory plan. The moment a plan is discriminatory, we make it taxable at fair market value in the hands of the employees. So we would want, so remember, what are these? These are tools in the hand of IRS to promote a certain habit between its people. That's the reason why you have all of these, the Obamacare came, which was now trashed. But then the idea was to ensure that the employer plays a very key role, because see, things like medical care, that's costly in the US. And it's very important that you have an insurance. Otherwise, it's going to really affect your life in the US, right? So, what we're doing, we have understood that anything to do with employer is good. Why? Because the employer will be forced to do whatever we are telling him or her to do, because the employer is dependent on us. And the number of employers are few compared to the number of employees, right? So, if you make it accountable to the employer, it works better. Okay. So, what is a fringe benefit? I would want the employer to provide certain benefits to everybody, not just to the director or the senior director or somebody like that. So, most of the cases where fringe benefits give you tax exemptions are when they are non discriminatory plans. Now, what is meant by this? We have a very good question on this. I will show it to you, Nick. But what is meant by this is this. If there is a non discriminatory group term life insurance where the company pays the premium, in that case, till $50,000 worth of coverage. This is not the cost of premium, guys. This is the cost of coverage. Till $50,000 of coverage, whatever is the premium that the employer or the employer is making, that's free. But the moment the coverage exceeds 50,000, then that premium will be taxable in the hands of the employee. And I will show you. There's a very good question on this, and I think it's very easy. You should be knowing this practically. Then there are some educational assistance. If there's some student loan or if there's some money that is being paid by the employer on your behalf, then there's a particular limit till that $5,250. It is tax exempt. Anything beyond that is taxable. Again, these are some kinds of fringe benefits only. Okay, guys? If what about the adoption benefits? Till $15,950 of adoption benefit is exempt. Dependent care benefit, $5,000, provided the dependent is less than 13 years of age, or if it is your spouse or any other dependent who's permanently, mentally, or physically disabled, then it would be that dependent. And the key, then the upper limit is $5,000. Now, these are indexed amount, which does keep changing year on year. So it's important that you know these typical figures. If the employer is paying the employee's share of the retirement, Medicare, Social Security, then even that amount becomes taxable. We've already stated this. See, there's a threshold. If you are if you're paying more than $2,600, then you have to furnish Form W-2. If you're paying less than $2,600, you don't have to furnish Form W-2 to the person who's working for you. Then we have these bargain purchases. What are bargain purchases? I go and sell something to the public at a higher figure, but to your employee at a lower figure. The delta is gross income in the hands of the recipient employee. Guaranteed payments to a partner. People form a partnership firm, and I'm paying a guaranteed payment to one of the partners. That means, irrespective of how much is the income or loss that the partnership is making, I am compensating one or more partners for the basic amount of time that they're giving to the partnership or some kind of a resource, either capital in the form of property, okay, or just cash as a loan they're giving. So I'm guaranteeing some minimum amount to that person, irrespective of my profits or losses as a partnership. That amount becomes wages, right? Because that's a wages fee for a person who's a recipient, but he's also working for his own company. That means own partnership. So he's also supposed to pay, he or she is also supposed to pay a self-employment tax on the guaranteed payment. Now, this is a very big delta between a partnership and an LLC, guys. If it's a partnership, the amount that a partner receives, you will have to pay a self-employment tax on that amount. But if you're a limited liability company, then the amount that the person receives, or even if you're an S corp, then the amount that you receive from the S corp, you don't have to pay a self-employment tax on that. So that's a very big incentive for not organizing yourself as a partnership, but going in for an S corp as a flow through entity. Okay. Okay. Look at this question. This is a simple question. Uh, okay, but this gives you a very good idea of what is taxed, what is not taxed. See, Jay worked in a factory and received an hourly wage of 20. I need everybody to do this question with me, guys. Okay, there's an hourly wage of 20. I have worked for 40 hours a week, and the number of weeks in the year are 50. So my normal wages is how much? Just calculate it, give me the figure. $40,000. Okay. He has also received a premium working for, okay, he worked 10 hours of overtime throughout the year. So there's an overtime amount, and even that is the amount paid for my compensation. How much is that? $10 at the rate, 10 hours at the rate of $30 per hour. So that means $300. He also received a premium pay of $5 per hour for working the night shift for his regular, that is non-overtime hours work. So how many non-overtime hours work, guys? This is premium pay. How many non-overtime hours worked? I worked 40 hours a week for 50 weeks. Now how much am I being paid? I'm being paid 5. So 5 was a 20, $10,000. Okay. There were 2 vacations. How much is a vacation pay? The vacation pay is around 1600. It is given to you. There's a bonus of 1500 that is also given to you. And there's a holiday pay, again taxable, of how much? 200. Add all that up. How much is it coming? 40, 50, 5500, 53, 53, 600. Entire amount is taxable. Now, this is typically an MCQ. I didn't want to give you the options. I've given you the full question. Is it clear? So this is what is offered for taxation: overtime, bonus, vacation, wages, all of that. Okay. Michael is a student who began working part-time as a restaurant server in October of year 4. Okay. Okay. He earned the following tips in year 4, with each month's tips reported in a schedule submitted to the restaurant management by the 10th of the following month. That means next month. So obviously this will be included. This will be included. This I will not take. We know this. In addition, Michael received a scholarship which provided 5,000 for tuition, 5,000 for room and board, 1,000 for travel, and 1,000 for books. How much is the amount that Michael should be reporting as income on his income tax return? Now here we already have seen tips. How much is the tip income? $615. Apart from that, when you receive scholarship for tuition and for books, that's exempt. Remember, only for tuition and books, exempt. When you receive it for room, travel, and stuff, that's not included in the exemption. So your taxable scholarship is 5,000 for room and 1,000 for travel. That is disallowed. So 6,615 is your taxable amount, which is reported as gross income in Michael's books. Now look at the next question. S works for a company that has a non-accountable plan. That means a plan which does not require the employee to account for the expenditures and or return the excess reimbursement. So no accountability is needed. The employee went and spent $200 on a business trip, and the company reimbursed her for 300. That means I received 300, I spent 200. How much is the amount that would be taxable in the employee's? In the first case, the entire amount becomes taxable. Most of you are correct. And in the next case, since it's an accountable plan, only the, no, not 100, guys, nothing, no, $0 will be taxable in the next case. You return the $100, right? Assuming you've returned, okay, yeah, that's an assumption that you can take. If you have returned that amount, assuming that you've returned it, it is $100. If you have not returned any amount, then 100. See, but the moment we say it's an accountable plan, it is assumed that the amount would have been returned, guys. Okay, it is assumed that the excess has to be, because that's what is meant by the accountable plan, that you account for the amount that you spend and you return the figure that is not spent. So in the next case, the amount taxable is 0. It is not 100. Is this clear? It is 0. Everybody, is it clear? When you say it's accountable, it is implied, unless and until they tell you that the person has kept that money to himself or herself. Okay. So a lot of questions in gross income for individuals center around fringe benefits. What are fringe benefits? Now, fringe benefits generally means something that you're getting from the employer, not in the form of cash. So basically, non-cash compensation. Something that you receive after you have worked for somebody, but the person is paying you in a way which is not in dollars. So what do? Ideally, if I look at the plain vanilla concept of fringe benefit, it is taxed as ordinary income. So the IRS will tell you if it is this, exclude. So there are specific exclusions. If it does not belong to any of those exclusions, the general rule is you offer it for taxation. Please remember, most of these fringe benefits have to be non-discriminatory. You cannot have a discriminatory amount, because the moment you have a discriminatory plan for fringe benefits, then the person who's receiving that has to pay tax at the rate of fair market value on the day of receipt. So general rules, most of the normal situations, what are your taxable fringe benefits? I am allowing somebody an external gym membership, not something that I'm having in-house. I am having automobile allowance that I'm paying for somebody who's keeping a personal car. Companies, jet, moving expense reimbursement. So see, at some point of time, there were detailed provisions on moving expenses and travel, but nowadays they have made it only for military people are exempt. So if you're working in US military, and there if you're moving from one place to another, and the cost of moving for your spouse and for your belongings and for your family, that will be exempt. But only if you are a military person, not otherwise. If there's anything that had to be paid by the employee, the employer goes and pays it. That is treated as a taxable fringe benefit. Parking reimbursements till 300. Again, this is an indexed figure that keeps on changing, but till $300 a month, you can get that as an exemption. Or any other thing which is not mentioned. So we are more interested in defining the exclusions than on defining the non-exclusions or inclusions. So we have other stuff. So we have these adoption assistance, as I already told you. It's still $5,000 for the year 2023. Now, see, general rule, I'm going to elaborate a little bit more on this when we're going to go and discuss Schedule C, okay? Because that's a time, and as an employer, what deductions you can get, that becomes important. But they tell you that, see, if there's something that you had to provide to an employee to remain valid in the work that you're doing, then that is a working condition fringe and that cannot be taxed. Say, for instance, somebody is working in a hotel, in a hotel industry, right? So they have to have a particular uniform. In that case, that uniform maintenance will not be fringe. Even as CPAs, when you start working, you will see that there's a lot of these membership fees and training expenses, your CPE training, and that is mandatory for you to remain relevant and also to retain your license. Even that becomes your working condition fringe. So if your company is providing that for you, that amount will be exempt for the tax net, and you will not have to report that amount. So if your CPE training expenses are being borne by a company, you will not have to pay for that in your gross income. Any athletic facility, so if there's a gym or something that the employer is maintaining, not regarded as uh, fringe benefit. Some minimum amount of fringe benefits that's just not material. We are not going to bother ourselves with it. I have a very good question on this. Okay. What they tell you is, if I'm into a business, say for instance, my husband works with Siemens. So every time we go and buy something which is a Siemens product, I get a flat 30% discount on it, irrespective of what that product is and where is that product being bought. That's an employee discount. Now, when I get a 30% discount, how much is the deduction that the company gets? Because had the company went and sold that product, let's say I buy a dishwasher or anything, if I buy that, how much is the deduction that the company is going to take? Because the company has got less amount, right? The revenues have been less. So we come up and say, okay, till one extent, to some certain extent, I'll give you exemption. But beyond that, if the employer is giving you a big amount of money as a deduction, is a kind of fringe benefit. So how I define that threshold, I say, see, anything up to the gross profit margin percentage of the employer. That means if my employer has bought something at 100, selling it at, let's say if my selling price was 100 and my margin was, let's say, 10%, that means my cost was 90. Anything till 90, I'm going to exempt it in your books. But if your employer goes and charges only 70 from you, in the delta 20, you will have to pay tax on that. So if it's goods, we are told that till the company's gross profit percentage, it will not be taxed. But anything beyond that will be taxed in your books. I find it very difficult to know how, people who are working in this field, if they can add some value, it will be great. But how does this work practically? I don't know. You would never know what is the gross profit of your employer, isn't it? Will the employer come and explicitly tell you that? I don't know. This is easy. For services, it's easy because it's just 20% of the fair market value of services. Now, till 20% of the fair market value of services, it is outside the tax net. But the moment you receive so I am I am receiving a service from my employer, and that service the employer is offering me at a price which is less than 20% of the fair market value. So that extra discount that I'm getting, that will be my gross income. I have to pay tax on it as a kind of deemed gross income for this compensation that I'm getting for the services. Stock option is a big area. We're going to do it later. Okay, because we are going to talk about incentive and non-incentive. This needs a lot of detailing in individual conversation. So we are going to do this later. This I've already told you, up to $550,000 worth of coverage. Whatever premium I'm paying, that's tax free. Beyond that, it will be taxable. So we'll see how is that calculated. Meals, we are going to discuss this a lot in Schedule C, but till 50% of the amount of expense covered is tax free. Entertainment, nothing is tax free. So if your employer is paying for you or entertaining clients on a yacht and taking them to exclusive or exquisite holidays and stuff, all taxable, guys. No business deduction, nothing for entertainment. They did away with it. There was such a lot of exploitation of that provision that the IRS has just eradicated any deduction on account of entertainment. Tuition reduction, I already told you, if for tuition and books, not for meals, not for rooms, not for boarding, not for lodging. Retirement planning, we're going to do it in great details when you're doing adjustments. Okay, and any other services that are provided free of cost to you by your employer. Okay, okay. Now there's something called cafeteria plans in the US. What is a cafeteria plan? I'll give you a bundle and I can tell you, you pick and choose what stuff you want from here. These are the benefits that you can get as fringe. Or instead of this, so this is what the employer can provide you, and I give you a card and I say, okay, Mark, these are the things that you would want. Or if you don't want the employer to pay for it, I'll pay you cash. I'm okay with it. And the IRS will not want the payment to be made in cash. IRS, because then I don't know whether the person is paying for the life insurance or paying for the accident insurance or the disability insurance, right? So what we say is very clear. If it is a cafeteria plan which you have chosen where the employer is paying for these benefits on your behalf, then I'm not going to tax anything in your hands. But the moment you choose cash, then any amount which is received in cash, I will have to ask you to pay tax of that figure. So anything which is there in the menu, and if the employer is paying it on your behalf, that's not taxable. But anything which is leading to cash in your hand because you chose that option is completely taxable, irrespective of how are you going to spend it. So this is termed as a typical cafeteria plan in the US. Okay. So look at these two questions. Okay. The first one. I think by now you should get a sense of how to answer these questions. Let's see the first one if you can answer. These employer offers a benefit plan that allows the employees to choose among a number of benefits. So this is a typical cafeteria plan question. Each employee is allowed $9,000 in benefits, for which the dependent care benefits is 4,200. We know till 5,000 is exempt, right? So I know this will be outside the tax net. $600 in a business course that improves Dorothy's job skills. So I know this is a working condition fringe and I will not be paying tax on this. And 3840, which is $320 per month in parking. Now we know only $300 per month is exempt. That means the balance 20 into 12, which is $240, will be taxable. And any amount I receive in cash is always taxable. So the total amount of taxable fringe benefits becomes $600. Is it clear? Everybody, is this clear? Okay. There's an employee whose employer pays $5,000 for the car payment that was supposed to be done by the employee. How much is taxable? So this is an example to the question that if there's any amount that you're supposed to pay as an employee and an employer goes and pays for that, then the full amount of $5,000 becomes taxable in the hands of the employee. Is this clear? Okay, start this question. Okay, what is this question telling you? Think nicely, okay? Mike was disabled last year. Okay, again, let's say you don't know any provision. We don't know how these provisions work. Think of what do you think is the normal that should happen, right? Mike's employer provided health insurance, paid his medical expenses of 50,000. That means there was an insurance policy that was taken by the employer, and the employer paid the health insurance for that. And now, since there was something that led to the disablement, there's an expense of 50,000 that was paid through that insurance policy. So there was a payout of insurance policy whose premiums have been paid by the employer. Is it clear? And his employer provided disability insurance, paid $40,000 for lost wages while he was disabled. That means there is one insurance that is for the health cost. There's another insurance the employer took to ensure that there's a monetary benefit that you get because now you will not be employed anymore. You will lose your wages. So there's a lump sum amount that was paid, and for that, the employer. So let's assume there's an employer who is hiring people in mining, where it's not very difficult to have somebody, or working in a factory where the disability because of a sharp thing hitting you, or that's very common. So the employer has taken a disability insurance on your behalf. In that case, how much should be taxable in Mike's hand? Just give a guess, guys. Just take a guess and tell me how much do you think we are going to tax in the hands of the employee? Remember, both these premiums are paid by the employer. Both the premiums are paid by the employer. How much of it is taxable in the hands of the employee? Okay, here I'm going to give you a concept, okay? See, one thing is called health. If there's a health insurance that is taken, Okay. If there's a health insurance that is taken and taken by whom? Who is paying the premium? Okay. So let's say premium paid by who is paying the premium? If it is the employee who is paying the premium, okay, if the employee is paying sorry, let's just first talk about the disability. Okay, let's just first talk about the disability. I think we are here. It makes sense if you're doing the disability insurance first. Okay, let's first talk about disability insurance. Okay, and let's assume that the employee is paying the premium. So when the disability insurance premium is paid by the employee, we are not giving any tax exemption to this guy. You're paying a premium, you pay tax on it, just a application of the money that you're receiving. But when the payout happens, when it happens, it's excluded. Why? Because I have paid the premium, I've paid tax on it at the time when I've paid the premium. So now when the payout comes to me, then the payout will be tax exempt. And it is immaterial, even if the payout is for lost wages. So I have paid for this. So I am somehow working in an environment where I feel that disability is a possibility. And in that case, I go and start working, but I've taken the disability insurance. Nothing to do with the employer. I took it. When the premiums were paid, I don't get any tax reduction. I pay. I I don't get any tax reduction. So when there's a payout, and it doesn't matter whether it is for meeting the personal expenses of mine when I'm dealing with that medical predicament, or is it for the lost wages. For both of the things, the payout is going to be tax free in my hands when I receive it. But if, uh, but uh, in case, if let's say I'm using it through a cafeteria plan, okay, so the employer gave me a choice, and one of those choices I exercised was the disability benefit. The premium was paid through the cafeteria plan. If that happens, then the payout will become taxable. Is this clear? If that happens, then the payout becomes taxable. Because I got a deduction. Remember, guys, one thing always understand. When you don't pay tax at the time when you're making the premium, then you have to pay tax when you're getting the receipt. When you pay tax, that means you don't get a deduction at the time, because this concept you're going to use so much in the IRA accounts also, right? When for the IRA also, you will see that at the time when I'm paying the premium, and if I'm getting a tax deduction, that means I did not pay tax right now. So when I receive that money at the time of payout, at that of time, it will become completely taxable. So this is an exception to the rule of when is disability insurance taxable in the hands of the employees. What if now this becomes a medical payment? And then just let me finish this concept, then I will take your question. Okay. Then let's say if I'm having something like a medical insurance plan. Okay. So general rule, uh, if so, that means what? If the employer is paying for the disability, and when you get that money, it is taxed in your hand. When you are paying for the premium and you get the payout, that is tax free in your hand. Okay. But this happens with disability. What happens if it's for health insurance? Okay. Again, if it's for health insurance, again, health insurance, and what would happen? The health insurance is if the employer pays the premium and you get the payout. Okay. If the employer pays the premium, you get the payout. And if it's a health insurance, it will be taxed in your hand. And if you have paid the premium and you have got the payout, then it will be exempt in your hand. So general rule, remember, if the employer paid the premium, employer would get a tax deduction. When there's a payout, it is taxed. But then I'll give you two exceptions to this rule. What is the first exception? If it is for a permanent disability. So this is an exception to the normal norm. Okay. General rule, look from IRS. When the payment was made, I gave somebody a tax deduction. When the money is received, I'm going to tax it. But for in order to avoid hardships, we have given you two exceptions. And if it's a permanent disability or if it's death, in both the cases, whenever there is a medical problem, I am not going to be taxing you in the hands of the recipient. So these are the exceptions. So in these two cases, the amounts will be non-taxable in the hands of the recipient. Is this clear? There's a taxpayer who's a general manager of F Enterprises. The dealership allows the employees to purchase up to 2 vehicles per year at a discount. The employer's average gross profit is 15%. And in this year, there were 2 cars that were purchased by the employee. What is the figure that should be included in the gross income of the employee? I am not giving you this working till the time I don't get an answer. I just want it for the first one. Tell me how much is the figure, if at all, that you have to report as income for the first employee. No, incorrect. Incorrect. What is the tax telling you? The tax law says till the gross profit percentage, it will be tax-free. Beyond that, it will be taxable. This is a purely arithmetic question, guys. Nothing to do with tax. Tax, I've already told you the provision. How much is the amount that will be taxable in the first case? How much is the benefit that was given to him? Okay. So how much was the benefit provided? How much was the benefit provided? The day when I sold that car, I had 61,000 minus 48,700, and that was a benefit that was given to me. So this is 12,300. How much is the maximum benefit permitted under the IRS laws? How much is it, guys? Gross profit percentage, which in our case is 15% of the selling price, obviously, right? GP percentage is always on the selling price. How much is it? So you've got something which is beyond the maximum benefit allowable. So what is the taxable benefit? The taxable benefit is this clear? I don't know whether these can be asked directly or not, but it can definitely be a part of your MCQ. Okay. I don't think we'll be able to do anything beyond this. Okay. This is everything to do with your group. Okay, this was a good question, guys. Okay, start this question because I've been looking for a question like this for that $50,000. I was not getting it for a very long time. Okay, look at this. K was hired by Van's company as a corporate executive and the board of director member. So this is a senior level guy. This year, he received the following payments or benefits paid on his behalf: salary, contributions, insurance premiums, year-end bonus, director's fee, group term life insurance policy, and the company car exclusively used by his wife. And they tell you that if you look at the IRS tables, there's a cost of insurance of $2.76 per $1,000 of coverage. Okay? Tell me, the first question that I have is, how much is the value of the group term life insurance policy that will be taxable in my hand? How? It's very simple, right? The excess is how much? The excess is $150,000. So 150 for each 1,000, you have 2.76. So $414 will be extra here. Now, out of all these, what are the amounts that will be tax-free? Tell me that. What will be the amount that will be tax-free? This is the amount that is receiving for his employer, right? So the health insurance premiums and the qualified pension plan. This will not be taxable. Apart from that, 414 will be taxable for group insurance policy. 8,000, since it's for the wife and not for him, will be fully taxable. The bonus and director's fee is fully taxable. Salary, of course, is fully taxable. So if you add all of this up, it's coming to around 1,18,000. So 118,000 or something. So full amount. So is this concept clear? The figure which is beyond $50,000 worth of insurance coverage. There is one last concept by which we'll be closing on this, which is called flexible spending arrangements. Again, Same podcast I was listening to, and there was this lady who had spent money on the FSA, made that contribution, and then she was stuck. And she was in such a bad situation that she had to ask people to buy the supplies on her behalf. So, what is an FSA? See, understand the concept, okay? There are some expenses that I will have to make during the year, which is related to the healthcare or the dependent care. So, I know there would be some dependent care cost and some healthcare cost that I will be incurring, okay? So, let's say I get a salary of $1,000 from my employer. That salary, let's say the tax rate for simplicity is 30%. I get $700 and then I get to spend this amount. And out of this 700, let's say 200 I know will be my qualified medical care cost, because I have seen my trend and there are some medical costs that I know I always have to bear. So what I do, I have this arrangement with my employer whereby I tell him that, see, you go and put this $200 in my name to the FSA account. And if that happens, the money that comes to me, that means, first of all, the money that goes is free tax. That means if I would have received that money, I would have received 200 into 70%, which is only $140. But now I'm telling my employer to go and submit the specified amount up to a particular limit that's allowable, which is 3,050 for the year 2023. I am telling that you please put that amount on my behalf, the FSA. So what do? I get $800. So earlier it was $700 that I got after deducting tax. Now I get 800, and after that I used to spend 200. That means my entire amount that used to be there in my hand was 500. Now what I do? I still go ahead and spend this 200, and the $800 I can do and spend on other things apart from that. So there's a total tax saving of around $300. So the entire amount on the taxes of that figure would have been saved. Provided, now that's possible, but provided within 2.5 months from the close of the tax year, I have to go and substantiate the payment of $200. That means I actually will have to spend the $200. If I don't spend that $200, then that amount is forfeited. Okay, that's the biggest catch. So this lady, so this was a podcast on talking about what are the various ways in which the taxes can be saved, and what are the pain points, and what are the hilarious experiments or hilarious situations that people have met with. So one such lady, she's put some $3,000, and now suddenly it was like 1.5 months left, and she realized that she had to spend those $3,000 over a span of 1 month, and there was nothing for which she could spend it. And then she was just buying her supplies, some of the medical supplies that she had in abundance, just to utilize that money. So it's a very good tax benefit, provided you know that you're going to spend that minimum amount. If you don't force yourself to spend that amount, then that's a very good tax benefit. Okay,